Welcome back to the last session of this revision session. We will be looking at question 4 of the March 2015 March Supplementary Examination paper. And the last question, this question 4, deals with fixed assets, cash flow statement, and a little bit of analysis and interpretation. I'm sure you have seen that in question 3 on the balance sheet, we also included just a little bit of analysis and interpretation as well, in the form of net asset value and market price of shares and the repurchase price of shares. Now, question 4. They said you are provided with information relating to Classico Limited. The financial year end is on 31 October 2014. New shares were issued on the first day of the financial year. Right, very important. The first question, they ask us, what is the main purpose of the cash flow statement? The short answer to that is that a cash flow shows the inflow and outflow of cash resources in a business. The cash flow shows the inflow and outflow of cash resources in a business. You can also say it shows how money is generated and spent how money is generated. It simply shows the sources of income or of cash, and how it's spent. It shows how do we spend that money that has been generated. I hope those two would suffice for now. Right. The second question says, refer to information C. Calculate the missing amounts indicated by A, B, C, and D in the fixed or tangible asset for the year ended 31 October 2014. Calculate the missing amounts for A, B, C, and D. This question is almost always in the paper, and it relates to your fixed asset note. Remember that you did this note, the fixed asset note, when you were in grade 10 and also in grade 11, and you also do it when you prepare your balance sheet and as well as your income statement. Right. Additional information here. They say a vehicle was sold at its carrying value on the last day of the financial year. Depreciation is written off at 20% per annum using the diminished balance method. Right. Let's go to A. A, they say you must calculate disposal at carrying value of land and buildings. I mean, this one is a straightforward calculation. At the beginning of the year, we had buildings to the value of 3 million. At the end of the year, we have buildings to the value of 2,500,000. And they say to us, land and building were sold at cost price during the financial year. Therefore, we have, at the beginning of the year, our land and buildings were 3 million. At the end of the year, our land and buildings is 2,500,000. Therefore, we sold land and buildings to the value of 500,000. We sold land and buildings to the value of 500,000. That one was a straightforward calculation. Anyone should be able to do that, really. B, they say we must calculate depreciation on vehicles. calculate depreciation on vehicles. And they told us that depreciation is written off on vehicles at 20% per annum on the diminished balance method. And they also said that the vehicle that was sold at its carrying value, it was on the last day of the financial year. Depreciation is written off on vehicles at 20% per annum on the diminished balance method. Right. Now, already we know that cost price minus accumulated depreciation would give you your diminished balance or your carrying value is 660. You don't have to calculate that. It's already given to us. You have your 660,000. You simply multiply that by 20 over 100. And that gives you 660,000 multiplied by 0.2. 132,000. You could have said multiply by 12 over 12 because it is for the whole year. It is for the whole year. So it was a straightforward calculation, 132,000. Number C, they say we must calculate the disposal at carrying value. Now, remember here we have already calculated 132,000. So what we are simply going to do is just a simple arithmetic calculation. We'll start with carrying value at the end of the year. Our carrying value at the end of the year is 446,000. 446,000. To this, remember, when you calculate going upwards, you do the opposite of what we do when you calculate going downwards. Remember that this amount we did what? We subtracted. Therefore, we are going to add it back. We are going to add it back. We are going to add 132. We're going to add the 132,000. So we want to calculate C and then subtract the 660,000. Therefore, you'll have 446,000 plus 132,000 minus 660,000. That gives you minus 82,000. Therefore, the answer here will be 82,000. Therefore, we have here 82,000. You will see when you say 660 minus 82 minus 132, it will give you 446. Those are, this is 9 marks that you are giving, just don't have to work really hard for it. D, they will say we must calculate the carrying value at the end of the financial year. Now, we know that carrying value is equals to what? Carrying value is equals to cost minus accumulated depreciation. It's cost minus accumulated depreciation. For an example, this side we said 750 minus 304, it gives you 446. Here we must say 256 minus something, it must give you D. Right. Accumulated depreciation at the end of the year. Accumulated depreciation at the end of the year is your accumulated depreciation at the beginning of the year plus your depreciation for the year, which means the amount here would be 55,500, 52,500 plus 55,500. Then we have 52,500 plus 55,500. That gives you 108,000. I've added this amount plus this amount. Accumulated depreciation at the beginning of the year plus depreciation for the year gives you accumulated depreciation at the end of the year. Now we simply have to say 258,000. Now to get the D, you simply have to say 258,000 minus 108,000. And I'm sure it will give you 150,000. I think those calculations were very basic. I don't think anyone would have struggled with those particular calculations. Fine, let's steam ahead. Let's steam ahead. The next instruction, which is the big one, carrying 24 marks, says complete the cash flow statement for the year ended 31 October 2014. Show all workings in brackets. The cash flow statement as well is very easy because they've given us the format. Cash generated from operations is given to us. You don't have to calculate that. Interest paid is given to us. You don't have to calculate that. What we have to calculate is tax paid and dividends paid. Now, to calculate the taxation paid, we always advise you to draw up your SARS income tax account. SARS income tax. But in order to calculate your SARS income tax, you will get your balances from your notes. You must get the balance of SARS at the beginning of the year and the balance of SARS at the end of the year. The balance of SARS at the beginning of the year, there it is 327,500. And it is under trade and other payables. Can you see that? It is under trade and other payables, which means it will be on the credit side. And then you say balance brought down 27,500. That is at the beginning of the year. At the end of the year, that is the balance of SARS, 22,500. But this time around, it is under receivables, which means now SARS owes us money, which means it is now a debit balance. Then you go to your SARS account. At the end of the year, you say balance carried down 22,500. What are we left with? We are left with the amount of tax that we paid during the year. How much did we pay for tax during the year? We go to our income tax. How much did we pay? Income tax for the year is 375,000. Then it must go on the credit side. Balance brought down goes with balance carried down. I'm sorry about this. Balance carried down, 22,500. And then our income tax. Our income tax, we are told it is 375,000. It's 375,000. Therefore, as you can see, in this particular case, all the entries are on the credit side, and then we'll have only bank on the debit side. Now, we have 27,500 plus 375,000 plus 22,500. That is 425,000. Therefore, you simply transcribe the information to your answer sheet. What will you say? Let me make it like this so that you can see. I'm going to say taxation paid, 27,500, which is the amount that we owed last year, that we must pay this year, at the beginning of this year. Therefore, it is an outflow of cash, plus the amount of tax that we must pay for tax for this year. This is the tax liability for this year, plus the amount that we overpaid. We overpaid 22,500 because SARS owes us 22,500. We paid more than the 375,000 that we should have paid. Therefore, it is also an outflow of 22,500. Therefore, the amount of SARS will be we'll have 27,500 plus 375,000 plus 22,500. That will give you 425,000. You see, all of them are on the credit side. All of them is plus, plus, plus. Right. Then we come to dividends paid. We are going to do the same with dividends paid. We are going to reconstruct our because we have not been given the interim dividends, we have given a total amount for final dividends. Then it means we have to reconstruct the shareholders for dividends account. And then here we are. We are going to open up our shareholders for dividends. Shareholders for dividends. It's a liability. It increases on the debit side and decreases on the credit side. And because it is a liability account, it has a credit balance. Balance brought down. As you can see, shareholders for dividend is always a liability. Both the opening balance and the closing balance are under trade and other payables, which means it is a liability. The opening balance is 385,000. There you are, 385,000. The closing balance is under payables, therefore it is a credit balance. You'll have balance brought down here of 450,000. There it is, 450,000, which goes with the balance carried down of 450,000. And then we were told that the dividends for the financial year is 825,000. The dividends for the financial year is 825. And those dividends will increase the amount that we owe. We'll have here your ordinary share dividends, 825,000. Therefore, we need to calculate the amount for bank. As you can see, the credit side is the bigger side. We have 385,000 plus 825,000 is equals to 1,210,000. 1,210,000. From that, we subtract the 450,000 minus the 450,000 that we have not paid. That will be 760,000. Therefore, you will see all the amounts on the credit side. I write them as positives. Then I will have 385,000 plus 825,000. And the amount on the debit side, I will write it as a minus 760,000. Minus 450. Minus 450,000. Minus 450,000. Then the answer will be 760,000, which is also an outflow because it is dividends paid. It is dividends paid. Now, to get the cash flow from operating activities, we are going to say to get the amount for cash flow from operating activities, we are going to say 1,985,500 minus 175,500 minus 425,000 minus 760,000. That gives us 625,000. Cash flow from investing activities. When you hear cash flow from investing activities, what must you think? Fixed assets, financial assets, right? Fixed assets, fixed deposit, right? Then we go to our balance sheet. You will see under our balance sheet, we have our current assets there, we have our shareholders' equity, we have a loan. We don't have any fixed deposit, therefore it's fine. It makes our work easier, which means now we have to concentrate only on the fixed assets. We said what? Assets that were sold. We sold equipment, we sold vehicles to the value of 82,000. We also sold land and buildings. Remember here we said we sold land and buildings to the value of 500,000. We sold land and buildings to the value of 500,000. Then we have here proceeds from sale of assets. Right? Land and buildings, 500,000. And then vehicles, we have 82,000. We have them, calculated them here. 500,000 plus 82,000. But remember, in an exam, whatever amounts that you have them here, if you bring them here, we'll give you credit for that. Even if you got them wrong on the asset. Please remember that. Ne? That you must take whatever amounts that you have there for disposal and put them here, and you'll get marks for that. Ne? Then the total, when you add the two, is 582,000. 582,000. No brackets because it is the money that came in. This is an inflow of money from the assets that we sold. Then the next item will be fixed assets purchased. Fixed assets purchased. Very easy, ne? Now you see, you again go to your note. What have you purchased? You see addition at cost. We did not buy any land and buildings. We did not buy any vehicles, which means we bought only equipment at 48,000. Then we have 48,000. Brackets, because we purchased, money went out. And then you get the total here. 582,000 minus 48,000 is equals to 534,000. 534,000. This amount is positive because the positive amount is more than the negative amount. And for these totals, you get marks, even if it's a wrong amount. Ne? Please remember that. For simply adding the amount in a, for these subtotals, adding the amounts in this column, you get marks. Don't forget to add or subtract where you need to. Don't leave these spaces open because those are actually free marks. Right? When you see financing activities, what do you think? Ordinary share capital, long-term loan. Ne? Ordinary share capital, long-term loan. Here we are. Ordinary share capital. They say CF. It was 3,150. It is now 3,450. You see that it increased with 300,000. Now let's go and see what happened there. Ordinary share capital at the beginning of the year of 2014 consisted of 700 ordinary shares with a total value of 3,150,000. On 1 November, 50,000 shares were issued at 6 Rand each. There were no further changes to share capital. Now, you come here. Proceeds from shares issued. How many shares did we issue? We issued 60,000 shares. Is that right? We said we issued 50,000 at 60 Rand. 50,000 shares at 6 Rand per share. You should know by now that 50 multiplied by 6 will give you 300. Now, let's use a calculator anyway. 50,000 multiplied by 6 Rand, it gives you 300,000. We sold the shares and we received money. Therefore, this is an inflow and therefore no brackets. Okay? No brackets. Right. And lastly, we go to our long-term loans. Where are our long-term loans? Here they are. Loan, we owed 1,375,000 at the beginning of the year. At the end of the year, we now owe 2 million, which means we have obtained an additional loan. Ne? Then we say loans obtained. This is not a repayment because it has increased. Now we owed 2 million. At the end of the year, we owed 2 million. At the beginning of the year, we owed 1,375,000. That is loan Freeport Bank. 2 million, 1,375,000. 1,375,000. There you are. You simply want the difference. The difference will obviously be 625,000. It's a loan that we obtained. Therefore, money came into the business. Therefore, it was an inflow of cash. Therefore, our total year would be 925,000. 925,000. Right. Then, to get the net change in cash and cash equivalents, and here as well, you'll simply get that much. Then we have to add the three amounts because all of them are positive. Ne? All of them are positive. Then we say 625,000 plus 534,000 plus 925,000 is equals to 2,084,000. 2,084,000. Now, cash and cash equivalents at the beginning of the year. I go to my cash and cash equivalents. At the beginning of the year, do you see how much it was? 207,500, and it is under current assets. 207,500. 207,500. And that will give me, and I must add the two together to get my cash and cash equivalents at the end. We have 005, we have 11, 8, 9, 2, 2, which means it's 2,291,500. Can I check now whether this amount is correct? Now, when I go to my cash and cash equivalents at the end of the year, it says I must have 2,291,500. And I compare this with my amount, then it means now that my solution is correct. But please, in an exam, if this amount is not the same as that one, don't try to waste time trying to make them balance. Go to other questions because this is only 1 mark and it is a method mark that you will get anyway. Because this mark you will also get by simply adding the three amounts, whatever amounts that you have. And then when you added this amount, which means here you simply have clean 5 marks, which are method marks for simply adding. So please make sure that you complete the statement. And if it does not balances, do not worry about it. Go and complete other questions, and you may come later on to it to check whether you are right or wrong. Right. Then next question, 4.4. The directors issued more shares and sold fixed assets in order to improve cash flow. A shareholder, Jane, meanwhile, has criticized them for these decisions. In this case, provide a reason to support John's opinion. Now, John says it was wrong to issue more shares. And he again says it was wrong to sell fixed assets. Now, why would you agree with John? Now, here, the reason why John feels this is because it will dilute the returns and by shareholders. Now, because there are more people, more shareholders, it means whatever money that is earned, it has to be shared between more people. That is why John is not happy about issuing more shares. Because now, instead of having 700,000 shareholders, you are going to have 800,000, which means whatever profit is made has to be split between more people. That is why he is unhappy. But what is the alternative? The alternative will be to go and get a loan. Therefore, the directors said, no, by issuing shares, we avoid paying interest on new loans. They said, no, we avoid paying, this is a cheaper option because we would not pay interest on the shares that were issued. Right. John again says, it is wrong to sell fixed assets. Why will you agree with him? Because there is loss on capital gains. Capital gains. What do we mean? We mean that fixed assets appreciate. Fixed assets appreciate. Therefore, if you do not sell them, their value increases. Ne? We gain what we refer to as capital gain. Their value increases over time, especially on fixed assets, ne? on land and buildings. But these people are saying we sold those things because they require maintenance. Unused fixed assets require maintenance. Therefore, if we sell them, we are actually saving on maintenance expenses. If we sell them, we are saving on maintenance. And then you will have your 8 marks. 1, 1, 1. Next question. Now we have moved to ratio analysis and interpretation. They say calculate the following financial indicators. Acid test ratio. We calculate the following financial indicators. Acid test, we know that it is current assets minus trading stock is to current liabilities. Current liabilities is very easy. There they are. You know, this activity is very simple because they've given you the amounts. There is your current liabilities. 1,450,000. Eh? Your current assets, they are given 4,804,000. 4,804,000 minus trading stock. There is our trading stock. There is our trading stock. 1,437,000. 1,437,500. Or simply, you could have just taken trade and other receivables and cash equivalents. Then you will get those. Instead of saying current assets minus inventories, you still get the same answer. Then here we have 4,804,000 minus 1,437,500 is equals to 3,300,000 3,366,500. 3,366,500 into 1:1,550,000. Now this amount you divide it by 1,450,000. It gives you 2,3:1. Your answer will be 2,3:1. And the marks will be 1, 2, 3, and 4. That is how the marks are distributed. Right. The next question says, calculate earnings per share. Calculate earnings per share. Your earnings per share, the formula is very easy. It's net profit after tax divided by number of shares. Where is our net profit after tax? Net profit after tax, there you are, 975,000. Divided by number of shares. Remember, what did we say? We said yes, 700,000 ordinary shares at the beginning of the year. 50 were repurchased, which means you are left with how many? 700,000 minus 50,000. It means you are left with 600,000 shares. 650,000 shares. The 700,000 minus the 50,000. That was repurchased. Therefore, here we divide by 650,000. See? No, the additional shares were issued. Is 700,000 plus 50. 700,000 plus 50, therefore it's 7. I thought the repurchased is actually issued. Therefore you divide by 750, multiply by 100 over 1. 975,000 shares divided by 750,000 shares. 750,000 shares is equals to multiply by 100 is equals to 130 cents per share. So we must always write it in cents. That is why we multiply by 100. Right. The next question says calculate the return on average shareholders' equity. You still use the net profit after tax. Net profit after tax is how much? 975,000. Average shareholders' equity, it's a half into, you go to shareholders' equity on your balance sheet. Where is your balance sheet? The amounts are already there. Ordinary shareholders' equity, there you are 400,000. 4 million, I meant to say, plus 4,450,000. 50,000 multiplied by 100 over 1. That will be 975,000. 975,000 over. This will be 8,450 divided by 2. It will be 4,225,000. Let me show it. Now, 400 plus 4,450. There we have 8,400,000. 4 million plus 4,450,000 is equals to 8,450,000 divided by 2 is equals to 4,225,000 that I have there. Then you multiply by 100 over 1. Then we have 975,000 divide by 4,225,000 multiply by 100. That gives us 23.07 cents, which is 23.1 cents, which is 23.1 cents. No, it's supposed to be percent. I'm now tired. I'm starting to lose focus. Right, nonetheless, we are almost done. The return is 23.1%. Earnings per share is shown as cents, return on average as a percentage, and acid test ratio as a ratio. At least that one is clear. Here they say calculate debt equity ratio. Your debt will be your non-current liabilities, or your loan is to your shareholders' equity. Loan is how much? Here we are. Loan is 2 million. Simply put the 2 million here. Your shareholders' equity is given. There you are. 4,450,000. 4,450,000. And then you simply say, it's always is to 1. You simply say 2 million divided by 4,450,000. 0.449. You can say it is 0.5 if you want. 0.45. 0.45 is to 1. 0.45 is to 1. Right. We are done with the calculations. But these calculations, will refer to them in the subsequent questions. You must not throw them away. Right. 4.6. The directors are proposing that the business operation be expanded in the new financial year. That is, we must expand the business. One of the directors suggested that they finance the expansion by taking a loan of 1,000 instead of issuing new shares to the public. Quote and explain 2 financial indicators to support his opinion. Now, the first financial indicator that you are going to quote is your debt equity ratio. Debt equity ratio is 0.45 is to 1. And this represents low risk. It's a very low risk because the business has 1 rand for every 45 cents that they owe. So which means now the business is mostly financed by own funds, right? The business is mostly financed by own funds. Therefore, it's a low risk. Therefore, we can take another additional loan. Right. The second one, you go to the table that has been provided to you. And you quote your return on total capital. You say your return on total capital employed increased from 18% to 26% and is higher than the interest rate. How do I know the interest rate? I'm going to look at my loans. Where is the interest rate? The interest rate of loans, there it is 12% per annum. 12%. Which means what? This indicates positive gearing. This is positive gearing. What does it mean? It means now we borrow money at 12% and we are able to generate 26% using that money. Therefore, it will be beneficial for the business to make use of loans because the risk is low and also the interest is 12%, whereas the total return on capital employed is 26%. Therefore, I hope that is fine. Remember, don't only talk about the debt equity. You must also talk about the return on total capital employed. Because if you talk about debt equity, you are only going to get 3 marks. Remember, this one you get from your calculations. But you must also talk about the return on total capital and compare it with your interest rate. If you end here, increase from 18% to 26%, you will earn only 2 of the 3 marks. You must compare it with the interest rate. Fine. 4.7, which might be your last question. Yeah, it's your last question, 4.7. He talks about Bongani here. Bongani is a shareholder in Classico Limited. He owns 32,000 shares, which he purchased 2 years ago at R4.75 each. Purchased when? 2 years ago. Calculate the amount of dividends Bongani will earn for the financial year ending 31 December. Now, that is a very simple calculation. They told us how many dividend shares does he own. He owns 32,000 shares. And then we are going to multiply this by the dividend per share. We go to our table that we've been given. What is the dividend per share? 110 cents per share. 110 cents. Remember, it's 110 cents, not 110 rands. Ne? Therefore, you say 32,000 multiply by 1 rand 10 cents. That will give you, is going to earn 35 rand, 35,200. 35,200. Do not, you see, this is 110 cents, which is actually means it's 1 rand 10 cents. Ne? Fine. The second question, should Bongani be satisfied with the dividend policy of Classico Limited? Quote and explain relevant financial indicators to support your answer. Now, when you're confronted with that question, you must compare your earnings per share with your dividends per share for both years. Ne? Right. In 2013, any dividends was 75 cents over earnings of 94. This is dividend per share. This is earnings per share, which means how much was paid out? 75 divided by 94. That is 79.7, which is almost 80%. 80% was paid out. That is when? In 2013. In 2015, dividends, we are told, is 110. These are your dividends per share. Earnings per share, remember we calculated earnings per share here at 130 cents. Divide by 130. Now here, you see No. 110 divided by 130. 85%. In 2014. Now, should Bongani be happy? Obviously, he would be happy. Yes. Why? Because payout increased from 80% to 85%. Someone might say it increased from 75 cents to 110 cents, but I want you to use percentages instead of nominal figures. But this is a short-term outlook. Ne? You are looking only at the short term, but if you are looking at in the long term, you will say no. Why? Because more and more money is paid out in dividends. And very little is retained for expansion. That is to grow the business. To grow the business. That is why I'm saying this is a short-term outlook and this is a long-term outlook. Or view. Right. 4.7.3, which will be our last question for today. They say, quote and explain the relevant financial indicators other than the dividends to discourage Bongani from selling his shares. Your answer must include the actual figures or ratios. Now, there are two things that you can talk about here. Ne? First one is the return on total capital, return on shareholders' equity. Return on shareholders' equity improved from 15% to, remember we calculated it somewhere here, average shareholders, to 23%, which is more than he will get from financial institutions. If he has invested his money in financial institution. Because look, how much did we get for the fixed deposit here? You look at the fixed deposit. Do we have a fixed deposit here? No. Wait, no. I'm looking at the, this is the right question. Look at the interest on fixed deposit. The interest on fixed deposit, you will earn only 5%. Financial institutions, where you will earn only 5% on fixed deposit. So he is earning almost 5 times that much for having the shares in the business. So it will be very foolish for him to sell the shares and invest the money in a financial institution. Right. The second thing that he must look at is the growth in the value of his shares. Remember, what did we say? We said 2 years ago, he bought his share for how much? Value of shares. Ne? Let's say the market price of shares. Market price of shares. 2 years ago, the shares, he bought the share for 4.75 Rand. But now, it is worth how much? What is the market price from our table? Prices on the Johannesburg Stock Exchange. 9.70 Rand. 9.50 Rand. You see, his investment has doubled in just 2 years. So he's actually getting a very good return on his investment in that company. Therefore, there is no reason whatsoever why he should sell his shares in this company. Right. This brings us to the end of this long revision session. I wish you well for the examination. That will be right in next week, Thursday. You still have enough time to prepare. I hope that this revision would assist you in that regard. Thank you.